Imagine two call options. Both have a delta of 0.50, but one expires in 45 days, while the other expires in just 2 days. The stock moves by $1. The first option's delta might move from 0.50 to 0.55, but the second could jump from 0.50 to 0.75. Same starting delta, same stock movement, completely different risk. The reason is gamma. In the previous video, we learned that delta estimates how much an option's price may change when the underlying stock moves by $1. But delta is only a snapshot. It doesn't remain constant as the stock moves. Gamma tells us how quickly that delta is expected to change. More precisely, gamma measures the expected change in an option's delta for a $1 move in the underlying stock. The easiest way to remember it is this: delta is speed, and gamma is acceleration. Imagine a stock is trading at $100. We buy a call option with a delta of 0.50 and a gamma of 0.05. A delta of 0.50 means the option should initially gain approximately 50 cents if the stock rises by $1, assuming everything else remains unchanged. But after that move, gamma changes our delta. If the stock rises from $100 to $101, the delta may increase from 0.50 to approximately 0.55. If the stock rises by another dollar, the option now responds with a delta closer to 0.55 instead of 0.50. The option becomes increasingly sensitive as the stock continues moving in our favor. If the stock falls from $100 to $99, the opposite happens. Gamma is subtracted, and the delta may fall from 0.50 to approximately 0.45. So gamma explains why an option's price does not move in a perfectly straight line. Its sensitivity changes as the stock moves. For one options contract, this is even easier to visualize. A delta of 0.50 represents exposure similar to approximately 50 shares. A gamma of 0.05 means that exposure may change by roughly 5 shares for every $1 move in the stock. After a $1 increase, our exposure could rise from approximately 50 shares to 55 shares. Long call and long put options both have positive gamma. However, put delta is negative. A put with a delta of negative 0.50 and a gamma of 0.05 may move to negative 0.45 when the stock rises by $1. If the stock falls by $1, its delta may become negative 0.55. This means the put becomes more sensitive as the stock moves lower, and less sensitive as the stock moves higher. Gamma is generally highest for at-the-money options. This is where the stock price is close to the option's strike price. At this point, even a small stock movement can significantly change whether the option is in or out of the money. That uncertainty makes delta change more quickly. Deep in the money call options usually have deltas close to 1, while far out of the money calls usually have deltas close to 0. In both cases, delta tends to be more stable, so gamma is lower. Time also has a major effect on gamma. As you can see on the chart, the option with 45 days until expiration has a lower, wider, and smoother gamma curve. Its delta changes more gradually as we move across the different strike prices. Now compare that with the option that has only 2 days remaining. The gamma curve becomes much taller, narrower, and steeper around the at-the-money strike. Gamma is now concentrated in a very small area. This means that near expiration, even a small movement in the stock can cause delta and therefore your directional exposure to change far more abruptly. At 45 DTE, the change is gradual. At 2 DTE, it can happen extremely quickly, especially near the money. However, this effect is concentrated around at-the-money options. As we move deeper in the money or further out of the money, gamma drops rapidly towards 0. So the shorter the time to expiration, the more abrupt the change in delta can become near the money. The longer the time to expiration, the smoother and more gradual that change tends to be. When you buy an option, you have positive gamma. As the market moves in your favor, your directional exposure increases. When the market moves against you, that exposure decreases. When you sell an option, you have negative gamma. Now the effect is reversed. Your position can become increasingly sensitive as the market moves against you. Before opening an options position, ask 3 questions. How close is the strike price to the current stock price? How much time remains until expiration? And am I long or short gamma? If the option is close to the money and close to expiration, expect delta to change quickly. So remember, delta tells you how sensitive the option is right now. Gamma tells you how quickly that sensitivity can change. Delta is speed. Gamma is acceleration. And in the next video, we'll look at theta, the force that constantly reduces an option's time value, and the reason traders are sometimes willing to accept gamma risk in the first place.